You've described it as sort of Main Street versus Wall Street up on Capitol Hill. Okay, there was a duel there. Did it change anything? Did it change the banks? Did it change the regulations? What does it change in the real world?
So, David, I'm lucky to have watched these hearings alongside my colleague and policy analyst, Nathan Dean, and we really thought there were four key takeaways. First is the Main Street versus Wall Street, as you referenced, and I think really focusing on the issues of the day on the retail side of the business, nothing really on the systemic risk, nothing on capital rules, and importantly, nothing about breaking up the big banks. So this is the first time in a while that we didn't hear that kind of talk. And so the takeaway there is that perhaps we are moving away from the focus on shifting capital rules and trying to get tougher capital rules for the banks. Secondly, overdraft fees. Obviously, this was a big focus of the meetings, especially with regard to Elizabeth Warren. And the takeaway there is really that we expect there could be something coming from the CFPB, especially with regard to these fees. And, part of that might be, it just might be a win, whereas different legislation might be harder to get through. Finally, the Wells Fargo, the asset cap, we have a call that we expect that to be lifted in early 2022. There was nothing to change that. And then lastly, I would just say that it was interesting to hear from the CEOs just in terms of what they see as the key risks. No surprises there really for out of the six, naming cyber, public policy and taxes from Jamie Dimon. Again, that's pretty consistent. But inflation, and then also Solomon talking about the global growth of government debt, which I also think is a key concern.
So, Darrin, I must say that I think that you were the front and center for an awful lot of this. That is the CDFIs, those community development financial institutions, as well as minority deposit institutions. A lot of talk about that. You're a CDFI. Give us a sense right now of the relationship between these very big banks and the CDFIs. We heard a lot of talk about how they're really helping you a lot. Are they?
I must say they are. This is the attention that CDFIs and MDIs have received during this pandemic. It has been unprecedented, particularly for a rural CDFI like Southern. We don't have a lot of overlap with very large Wall Street banks in our markets, and so we really hadn't had their attention before. But we now have the attention of Wall Street banks, and they're looking for true partnerships. And I must applaud their efforts. For example, Bank of America. They've made a multi-million-dollar equity investment in Southern Bancorp. And equity is the true capital that allows us to leverage and grow. And I've had several conversations with Brian Moynihan, and he wants to extend that relationship well beyond just making an equity investment, but also developing true partnerships. So we are talking more and more with members of Bank of America and finding ways that we can share resources, share technologies, and really help to serve underserved markets and underserved communities. So I applaud the efforts of Wall Street, particularly Bank of America, which we have a strong relationship with right now.
So, Alison, we heard a lot of talk from the senators and then the congressmen about how we need to make more loans to more challenged businesses, smaller businesses, minority businesses. We didn't hear much about the standards of those loans. And I wonder if there's something of a tension here between, on the one hand, after the great financial crisis, really tightening up those standards, making sure the loans were being made responsibly, and making sure we're servicing some of the people who need it the most. Can you do both of those at the same time?
Well, I think you can. I think you heard a lot about the programs and a lot about financial education, helping to educate people, helping to invest in the communities. And I think that's really where banks can do a good job. But to your point, you do have to be careful of the standards. Obviously, a big problem with the last crisis is that there were a lot of loans made that should not have been made. But at this point in the cycle, if you look more broadly across the banks, the issue really is not their willingness to make loans. They're more than willing to make loans. They have a ton of capital, and they're looking to make every loan that they can. It's really the demand side of things. And I think you do have to be careful there because you don't want to manufacture demand or go after that too aggressively, because you do want to keep the quality of that lending. But again, importantly, you saw that each of the CEOs, when questioned about this, talked about the programs that they do have in place to try to expand financial inclusion.
Darrin, what about the demand side? I mean, you're down there in the Delta, in Arkansas and Mississippi. What are you seeing down there in terms of demand for the small businesses? Because I know you go out and you make customer calls.
Absolutely. We make customer calls and we see a steady demand. In fact, year over year, our loan demand's grown about 5%. And so here's where the relationships with larger banks and CDFIs and MDIs really can be important because we have relationships. We're proximate with the small business. So last year, for example, we did 7,022 loans. 47.4% of those loans were for less than $10,000. And that's not a loan that a large bank is really positioned to make. And that's not a knock on them. They're just not positioned to make that. But that's the type of demand that the small businesses in our markets need. And they don't need a 23, 24, 25% interest rate credit card for that. They actually need a reasonable rate, and we're able to provide that to them and then do much larger loans. But we're seeing a strong steady demand. That's a 5% net growth absent of the PPP loans, which we did over 2,000, over 150 million so far in paycheck protection loans we've done so far.
So, Alison, take a broader view here right now. We also had on Friday the budget come out, the proposal from the White House, with a lot more spending anticipated. What does that mean for the big banks? Are we looking at a steeper yield curve? Are they going to make more money in this new world?
Well, a steeper yield curve is obviously positive for banks. And, there's been a lot of talk about banks being inflation hedges. And I think that's been supportive to the banks. But at the end of the day, for the banks, you really need short-term rates to come up. And that's not going to happen for a while. So the steeper yield curve does help, but it feeds in over time. But at the end of the day, as Brian Moynihan pointed out, it's all about the economy. And as Jamie Dimon pointed out, what are you spending the money on? Make sure that the money that you're spending is contributing to growth. And I think that's what's going to be important for the banks in the long run, to the extent that we can get better economic growth and eventually get an economy where we can have those short-term rates rising.
Darrin, what are you seeing at a grassroots level there in the Delta, down there in Arkansas, in terms of the economy and the spending from Washington? Is it really taking hold of some of your customers?
Well, what we see is that we see quite a bit of money in the markets, or quite a bit of money in our accounts. We're at all-time high in deposits. So I think the stimulus dollars, they're having an impact on people. But we see people really cautiously optimistic about trying to build back, to grow back from this pandemic. Things are slowly starting to open up. We are beginning to see much more business activity, and that's promising. Our job is not really to guess where the rates are going to be. Our job is really to try to manage the spread. And of course, we do need spending on things that will grow the economy. I must agree with that. We need, for example, in the Delta, we need spending on broadband to increase business access and business opportunities. We need spending on bridges and on roads. For example, right now, the I-40 bridge between Arkansas and Tennessee is closed down through August. That's a major thoroughfare for truck traffic. We need things. We need money to be spent by the government on things that will actually grow demand and boost business.
Alison, you referred earlier to the overdraft fee issue, the little contretemps, if we can call it that, between Senator Elizabeth Warren on the one hand and Jamie Dimon of J.P. Morgan on the other. It was pretty dramatic, actually. How much money does a J.P. Morgan actually make off of that? I mean, if I were Jamie Dimon, I came away from that, I'd almost say, forget it. Let's not charge it anymore. It's not worth it.
Sure. And I think, the focus on, I would say, so this is sort of one part of the overall package, right? Because, there are overdraft fees, but then there's the overall value of the account and overall what you pay for the account. And so in general, and I should note that over time, the rules have changed, and it is an opt-in product that went to that several years ago. And then you've had someone like Bank of America introduce a product, $5, you pay $5 a month and you won't get these fees. That's about 30% of their base now. And their overdraft fees, are in the range of 1.5 billion, but they're down from 5 billion over 6 to 7 years ago. So this is really only like 1 to 2% of their revenue. But I think, too, it's interesting from the broader perspective that there's actually a competitive war going on with regard to these fees. We've had these fintech companies like Chime and Varo coming in, not charging fees. And we've had some of the regional banks, such as Fifth Third, coming in and saying, we're not going to charge these fees. And Herman Chan, who's our regional bank analyst, has done some work on this with Julie Chariel, who's also the fintech lead, just in talking about the fact that the regionals are cutting these fees just to compete. So I would say the clear message on overdraft fees is both from a competitive purpose and from a regulatory purpose, as that this is a source of revenue that's going away for the banks. Again, it's 1% to 2% for the big banks, more like 3% at the regionals.
But is it fair to say, Alison, that's not the biggest problem we got in banking today?
It's not. And as I said, if you think about it, right, it's one fee on the on an overall account, and sort of an interesting focus.